so much for logging into our virtual event. And we're joined by OneVentures, and we're going to be exploring the topic of venture credit. So this event was originally run out of our event space in Sydney, and it was a sellout of event. We were chatting before in preparing for this with Michelle and Nick, and you were saying you had a lot of questions come through, and in the end you kind of had to find your way out of the building. So I'm hoping that today is just as inspiring and interesting to everyone on the call today. And we're so happy to have you back here to do this webinar. I hope you've all managed to find a comfortable seat, and I've got a coffee here, which you'll see me sipping occasionally. I'm speaking to you from Adelaide, from our Stone and Chalk lab. I'm actually in a small studio with a green screen, but behind me is the image of our main event space where we often run events. And some of you, I can see you coming through, have been here for events, so it's good to have you come back and join for virtual events. Now, in anticipation of questions, we are expecting a lot and we welcome them. Please use the Q&A function down the bottom of the screen. You can already see we've got a question coming through, so that's great. So you can use that at any time throughout the presentation, and at the end we'll come to your questions. We're also going to have a short survey, and we would love it if you could please fill out that survey. We're constantly wanting to improve the events we're running for you guys, and appreciate any feedback, ideas, suggestions, or contributions that you have. So a lot of you are familiar with Stone and Chalk. Those that aren't, we were founded in FinTech in 2015, and we're a non-for-profit organisation. And our mission is really about connecting, nurturing, and propelling those who are seeking to solve the world's most pressing business and social challenges. And so in that sense, our founders, many of you on the line, our corporate and industry partners, investors, mentors, we're all shaping the future together. And so we've got this proven track record over the last 5 years in developing successful growth and support frameworks for founders especially in emerging tech sectors. So we started in that FinTech, but now we're exploring new and interesting opportunities. That's everything from space tech, prop tech, med tech, ag tech. There's a whole range that we have, a lot of machine learning and AI in particular here in Adelaide, which is awesome. And today, the reason you're all here, we're joined by Michelle, Nick, and James from OneVentures Credit Fund. Now, OneVentures is Australia's leading venture capital firm, over 400 million in funds under management, but they're really keen to do more than invest. And you'll hear this throughout the presentation. It's about taking companies to that all important next step and using years of international experience. You hear a few accents in the presentation, no doubt, operation and execution expertise to accelerate the growth of the portfolio companies. It was launched in April 2019, and it has around 60 million available for high-tech growth tech, or like high growth tech companies available right now. It's focused on those rapidly growing companies that are differentiated through technology, which is the category that a lot of our founders fall into, as especially a focus of those with strong revenue growth. So this is particularly interesting for those founders I can see on the call who are working in SaaS, FinTech, marketplace, e-commerce spaces. And we've got some exceptional founders and leaders here, which is excellent. I guess the niche is in that 3 to 5 million in revenue point. But that's not my area to talk through in any more detail. I'm going to hand it over to Dr. Michelle, Managing Partner, to introduce the team and also introduce your hosts for the session. Thanks, Michelle.
Yeah, thanks, Dan, and thanks to the crew at Stone and Chalk for hosting today's webinar. Really appreciate it. We've got some slides that we're going to share. I think Nick's going to put them up, and I'm just going to give you a bit of a run through on some background about OneVentures. So if we can go to the next slide. Just as an overview, you know, OneVentures was really founded by entrepreneurs. So we understand the journey that you're going through. We've built and grown companies. We've taken them to the international stage. We've sold those companies. We've come back as angel investors and then actually built and grown what's now quite a large Australian venture capital firm. And, hired a great group of people around us that can help you as you're building and growing your businesses. We have 22 active portfolio companies. I think we've backed 27. We've exited a number of companies along the way, working with those founders. And another important thing is our investors are people who have built and grown large businesses themselves. So we're backed by about 120 Australian and international family offices, and they run businesses across all sorts of areas like retail, fintech, IT, healthcare, media, financial services. And that gives us a bit of an advantage when we're working with our companies, because they can help open doors. They might even put in some personal capital. They can certainly make introductions to help you grow your business. So just next slide, Nick. So we have 4 funds in market at the moment. Our healthcare fund and our venture credit fund are actually actively deploying capital. So we're looking for the next great business, which might be your business, to come in and be part of our funds. We're also raising a growth fund as well, which is available for those scale-up companies down the track. So, you know, we're looking for new opportunities for our funds. So, you know, come and see us and share your story. Next slide. Thanks, Nick. So we're really proud of, you know, our portfolio companies. They, you know, all come in, they're all trying to solve big global problems. They're disruptive, they're innovative. And, you know, maybe you're going to be the next company to join our portfolio. But just to highlight a few companies, we've got Vaxxus, which is a vaccine nanopatch company, very topical right now. It's going to replace the need for needles for vaccination down the track. We've got Focus, which is a SaaS business insights and intelligence platform. It's growing globally. We're helping them with their business, now like quite large in revenue and expanding very rapidly in the US market. You know, some local players like Ed Rollo in the e-learning space, growing out their education business. We've got an AR, VR company in our portfolio that's, you know, spearheading the move to 5G and the fact that, you know, we're going to be looking at 3D content in the future as a way of, you know, experiences and having new experiences. So we've got, you know, a large range of companies in our portfolio, and, you know, we're really proud of them. One right now is helping all businesses in Australia with their HR in the cloud and helping people access JobKeeper, and that's Employment Hero. So, you know, great companies in our portfolio. Next slide. Thanks. So I'm going to introduce you to some of the team. But first of all, just mention that we've got a fantastic board of directors who are some of Australia's most experienced business leaders. You might recognise somebody like Peter Gamble, who's, you know, was Kerry Stokes' right-hand man. Simon Moore, as another example, was a managing partner globally for Carlyle Group. So great people to have on our board. Myself, you know, I was one of Australia's first fintech entrepreneurs. In fact, I went through a tech crash, so I know exactly how you feel right now, going through this, you know, COVID-19 crisis and the impacts on business and how you work through that. You know, I managed to grow and sell my company to a UK publicly listed company who I worked for, and then I started angel investing before establishing OneVentures. My fellow managing partner, Paul Kelly, Paul founded a company called Gemini Genomics, which was about genotyping diseases. He took it to the UK, raised 40 million out of Europe, and ended up being the UK's largest NASDAQ listing at the time. And then that company was sold to $1 billion company called Sequenome. He did another NASDAQ turnaround, took it from a $30 million to $300 million market cap, living out of Boston. And then we were very fortunate he wanted to come back to Australia and joined the start of OneVentures as a founder. Anne-Marie Burkle ran iLab Incubator for Queensland Government and was with UniQuest, so highly regarded in early stage business commercialisation. And Grant Chamberlain came to us as head of M&A at Merrill Lynch, where he's done over $50 billion in M&A transactions. So a great person to have with us. We have 2 venture partners in the US, Dan Baker and Jim Scoper. Nigel Jews is one of our operational partners, so we embed him into portfolio companies. He was formerly head of Fairfax Digital, formerly CEO of Vodafone. He worked for Hutchison in Europe. He's come back. He did another business called Message Media in Melbourne, which he was involved in the turnaround of that business. And now he's working for OneVentures, actually in our portfolio companies. And I'll just mention Nick Gainsley. Nick's here to present today on the Venture Credit Fund, but Nick joined us from Europe. And if you just move to the next slide, thanks, Nick. You know, we've got a really terrific venture credit team. So Nick joined us from Kreos Capital in Europe. Kreos is one of Europe's largest venture debt firms, I think about 3 billion under management. And before he was at Kreos, he'd spent 7 years in the debt advisory business of KPMG. But Nick's managed about 500 million into about 100 companies doing venture credit. So he really knows this product. I think he's the most experienced person in Australia in managing and working with businesses who take venture credit. James McGrath has been part of OneVentures for over 4 years. He really spearheaded the development of this product in our firm. And James also worked prior to OneVentures in the debt advisory and M&A business of Credit Suisse, Citi and Alia Capital. And we've also been delighted to have Kate Madden join us. Kate's from Ireland, and she spent nearly 4 years in PwC's business restructuring group and also did a secondment with KKR and their private credit team. So we're really happy to have Kate working alongside us. So they're the people that you would deal with day to day if you approached OneVentures for venture credit. But additionally, as part of this fund, we have a partnership with Viola Credit of Israel. And Viola Group in Israel is like the Sequoia of Israel. They've got about 3 billion under management. They're partly owned by Goldman Sachs. And Ruthie Simha founded the Viola Credit Group when she moved back from Silicon Valley 18 years ago, and they've been running this product for 18 years. And they serve weekly, they join our weekly team meetings on the companies we're looking at. They give us access to larger amounts of capital if we need to do a bigger raise for your company than maybe what our fund can do. Viola Credit can also participate in the round. And they can also help on the international stage with our portfolio companies that are going into international markets. So I'm going to hand over to Nick now to talk about venture credit. Thanks, Nick.
Thank you, Michelle. Hopefully everyone can hear me. Before starting, I just want to run a quick poll question to kind of get people's sentiment. So you should see something come up on your screen. I'll give you kind of 30 seconds or so to answer the question. And just to give you kind of background on what we're going to cover today, we're going to do a few slides, just really high level in terms of debt and debt versus equity. So kind of very basic kind of introduction to debt. And I'm going to dig more deeply into kind of venture debt, venture credit specifically. And then after that, we're having a kind of Q&A session. So keep sending your questions through the Zoom, and we'll address them at the end. So in terms of the results from the poll, you should be able to see them on the screen now. Interestingly, everyone's saying they feel worse. And this is the question here, if you read it here, is kind of how do you feel today versus a month ago, kind of at the heart and the real height of COVID-19. Interesting, people are feeling worse. So I suppose there's just real uncertainty in the market right now in terms of how things are going. You know, even with the cases of coronavirus coming down, how that impacts wider conditions is very unknown, and it definitely is pretty uncertain times right now. So we'll definitely cover off later on kind of how this product interacts with the current market and what it means and how it can be used or not used. So let's jump in. So first, I just want to kind of look at the differences between debt and equity. I mean, the key difference is really around the return of the two kind of security types. With equity, it's generally going to be more expensive for the company, but you're not guaranteeing any return. So you're only getting return for those shareholders through dividends and capital appreciation, but that could be nothing. It could be unlimited effectively. Whereas debt is kind of very, very different. It's way cheaper for the company overall, but you're agreeing to a contractual fixed return, and that return comes through interest and fees. And then structurally, in terms of how they differ, because of those differences in risk profile, debt is a senior product, so they get their money back first, whereas equity is junior. You may have some liquidation preferences which change exactly how far down the structure you are, but invariably you're always lower than debt. In terms of the nature of what those investors want, because of that unlimited return, they have much more say in the business. So you have voting rights, you direct the business, depending on how much you invest, you may have board seats. And from a risk perspective for the company, it's much lower risk taking equity because of that non-contractual return, whereas there's a little bit more risk with debt because you're fixing repayments. And the last point there on the kind of strap line is really important for later stage businesses, but less important for earlier stage. But debt is tax deductible. So you can actually pay out your interest before you pay tax on your taxable profits, but you need to be profitable for that. So unfortunately, it probably doesn't apply to most people out there. Just in terms of the real benefit of debt is all around the magnification effect, which is caused by that contractual versus unlimited return, which we just talked about on the previous slide. So effectively here, just taking a very simple example, if you had $1 million of cash, say, and you decided I want to buy, invest in property, if you put 100% of your money, so you put 1 million and bought a single property for 1 million in cash, or you split your money into 10 $100,000 chunks, and you put $100,000 of equity and took a mortgage out for 900,000. Effectively then, if the property market went up 10%, with a pure equity example, you'd make 10% increase, or if it fell, you'd lose 10%. Whereas on the example where you take out leverage, actually you magnify that return 10 times. So you make 100% return. So actually you turn your $1 million of cash into $2 million. But then on the flip side, if things go badly, you lose everything. So you'd have 100% loss. So you really magnify that up and down effect. There's lots of different types of debt facilities out there. And this slide here kind of look at different repayment profiles. So a bullet loan is where you're paying back the loan in a single bullet at one point in time. And generally you're just paying interest until that point. Whereas the opposite to that is an amortizing facility in the bottom left here, which is really when you're paying down the capital in chunks. So that's a little bit more like a mortgage where you'll pay back principal and interest on a monthly basis. And then different nuances of those amortizing facilities, you may hear something called a revolving credit facility or an RCF. Effectively, all you're doing then is taking lots of little bullet loans and you're paying back the capital and paying the interest at the end of those interest periods. So those interest periods could be as short as, they could even be as short as a week, but generally there'll be a month, 2 months, 3 months, 6 months. And you'll keep taking multiple term loans and therefore you'll get a profile like those up and down step profile. They're more suited to larger businesses, and larger corporates often use these facilities because it gives them more flexibility around when they take or don't take money. And in the bottom corner is an overdraft, which is really a kind of a nuance of a facility which goes up and down. But typically it goes up and down on a kind of a daily basis or even kind of an ongoing continual basis, whereby you may have a cash balance which makes you positive, or you may draw down and you go up and down very frequently. So they're different facilities. I now kind of want to go into venture credit specifically. I actually have another question for people first, just to kind of gauge their understanding of venture credit. So just kind of an open question here in terms of how much you know already, so I can kind of gauge knowledge. So if you just answer away, we'll see what people's views are. I mean, generally this product is actually very, it's pretty new in Australia. It's only been around, we've only been around for a year doing it. There's other people in the market been doing around for a few years, but it's still very nascent. So generally people don't know too much about it, to be honest. Okay, so let's stop that. So in terms of the results, most people here, so kind of 74% are saying they don't know anything at all, or they've heard a little bit about it, but not sure how it works. So look, for those who know more about it, some of the stuff here is fairly basic. We can jump more detailed and more advanced later on. So it's good to know. Okay. Okay. So what is venture credit? Really, all it really is a form of debt which is very flexible and suited to high growth businesses. So what I mean by that is, typical bank facilities are very structured. Banks look for stable, profitable businesses, which are very, very predictable. And generally kind of earlier stage high growth tech is more unpredictable, growing faster and changing often. And therefore banks find that hard to understand. So venture credit is a product which is set up specifically for that purpose. What it does is, if you look on the chart on the right, effectively by taking on some debt and some equity, you have more availability of capital at any point in time, and you can get further until that next funding event or the next stage of your business. So by taking debt here, if you're looking at the blue line, effectively you go further each stage. You're delaying those financing rounds, and when you do raise money, you'll be at that next stage in your business. So you may have reached a certain scale, which means you can access a certain type of investor. You may have proved out a new product. You may have launched in a new market. And those things will really allow you to step up in valuation higher than you would have if you had raised earlier. So by keeping raising venture debt alongside equity, you actually go further in your business and end up diluting yourself less. So it's a really attractive tool. Because of the flexibility, effectively you can spend it like equity. So what I mean by that is you're not restricted saying you must spend it on working capital or you must use it to do this, and you're restricted otherwise. So it gives you that option like equity. And the last point there is it actually improves returns for other investors around the table. So that can be both, third-party investors into the business, but also founders themselves who, as you raise more and more money, you're getting diluted every time. So by saving that dilution, you're leveraging your return, much like the house example previously. So different use cases for venture credit. Just kind of touch upon 4 different use cases here. So the reducing dilution point is a point we mentioned before. You may raise a round and decide, okay, let's raise some equity and some debt, and therefore you've got a smaller overall equity check and reduced dilution. There may be a situation where you need to raise money between your formal rounds. So say you raised a Series A and a Series B, and you're not quite ready to raise that Series B. So it may make sense to take some debt in between. It could be in conjunction with equity from your internal investors. It could be debt on its own. And that will take you further and make sure you achieve those goals before that next round. The third one there is kind of, you choose to take it instead of equity completely. You may be between rounds, you don't need any more equity, and therefore debt is a good way of scaling your business. And the last one, really important actually in this market, is kind of using debt as an insurance policy. So what I mean by that is you have a credit line open, and if you need it, you can choose to draw down the money. So it may mean that actually you're seeing that your burn is higher than you expect, and maybe because demand for your product is lower, market conditions are tough like they are today, and therefore growth is slower, which means you haven't quite got to where you want to get to when you run out of money. So actually having that money available to draw down is hugely valuable. But it could be also actually on the other side where things are going very well. You may see opportunities in market. Maybe there's, a new product you can launch or a new feature, or it might be that you see a new market that you can want to enter, and without access to capital, you can't do so. And if you have a credit line, you can therefore use it and take the money and move into that area. So in terms of pros and cons of the product, I mean, obviously nothing is all good and no bad. There's obviously always kind of things to consider on both sides. Just running through some of these things. So we've touched upon a number of them, but you're saving dilution and the product is cheaper than equity. So overall there, you're improving your returns to your other investors. So that's important. You're not changing your board. So we're not looking to come in, take a board seat, direct you and help guide the business and tell you what to do per se. And therefore actually you retain more control at a board level, which is important. You also really, really importantly avoid pricing around. As a lender, we're not looking to set a valuation, buy shares in your business. And therefore by not setting that round, one, you may not want to because you may be at a point where you won't achieve necessarily the best valuation. That could be on the extreme end of down round because you've gone backwards, or there's been a real shift in market conditions which have meant that valuation multiples mean you've actually got a lower valuation. Or it may be that you just don't want to set a valuation today because you're seeing a next round in a year's time or 18 months time, and by delaying that pricing, it's attractive. One, could have multiple implications. It could impact your ESOP. It might have implications on your existing investors. You have to write down their investment. It could make it difficult to raise money. So that point's really, really important. You get the benefit of bringing in a new investor without, bringing on another shareholder. So if you bring on a venture debt provider like someone like ourselves, you get the benefit of OneVentures, our platform, how we can help in different ways without taking on a new investor. Also, it's much quicker. In terms of putting in place a venture debt facility, typically it will take about 4 to 6 weeks, which is probably 2-3 times faster than equity. Equity often takes about 3 months. In this market, it could take even longer. So that's really attractive. On the downside piece, I mean, one, you've got to pay interest first and foremost. So there's a cost there, and there's an ongoing contractual cost to the business. In terms of ranking, it sits first. So we would come in above any existing equity and above any pref equity. So that's just something to bear in mind. It's not right for every situation. Businesses which are not quite at the right stage, they're having issues, it may not fit for everyone. So it's not always available, whereas equity essentially can be used in any circumstances. And often it's a smaller size check than equity. So normally it's a proportion of the round rather than the whole round. And so it may not give you enough on its own. In terms of kind of how it looks, what it typically is a term loan, like I was mentioning before, where you're paying down the capital over time. So normally there can be a period where it's just interest only, but then typically after that, you'll pay equal monthly payments of principal and interest, much like a mortgage where you have P&I. It often has equity options, which are called warrants, and I'll come on to that later, but effectively that gives some participation in the equity upside to the lender. It also really helps align interests. Ultimately, we want the same thing as the shareholders around the table. We want the business to thrive, we want it to grow, we want to maximize value. And by us participating in some of our equity, it really aligns interests and drives kind of aligned decisions later on in the business. It's senior, it's secured. And what I mean by security there is, we'd look to take, and the same with any lender, look to take a charge over the business. So in Australia, you can take a general security, whereby you have kind of a floating charge over all of the assets of the business. We're not taking any director's guarantees, so you don't have to put your house up on the line. It's very much we'll look and assess the business and lend to the business alone. And the last point here around covenants is generally it's fairly covenant light. And what I mean by that is a covenant is basically restrictions in your business on certain things you must do. There can be negative covenants, things you can't do, but generally it's things you have to achieve. So when I'm saying that, it's basically you haven't got to grow your business in a certain way. You might not have to hit certain metrics each month. With a bank loan, you probably have covenants around how profitable you have to be each month, how much income you've got to have relative to the cost of your debt payments. With venture credit, a lot of those metrics don't apply. But even then, typically a venture lender won't test you on lots of different bases. So you wouldn't have to hit certain revenue each month, ensure that your margins are at a certain level, ensure that your cash is at a certain level. I mean, it may or may not depending on the situation, but generally they're lighter than other types of debt. No ranking here, I've talked about ranking, but this just depicts what I mean in terms of the waterfall. So this would apply at any liquidation event. So if you sold your business, in terms of the order of when people get their money back, senior debt sits first, and venture credit is normally senior. In more mature businesses, it may be junior debt or mezzanine debt, which will sit below that. And then the last three buckets there are all equity or quasi-equity. So a shareholder loan, a convertible note or a safe note is generally, it's equity, but it's still structured as debt. So it sits below other types of debt, but sits above other types of equity. Then you may have had pref equity in your business. And then lastly, there'll be ordinary equity. So in terms of terms specifically, these are kind of key things which people ask about and key kind of terms of a venture debt facility. So in terms of size, and this will really depend on the lender, but this applies to OneVentures specifically. We lend anywhere from about $500,000 up to about $5 million per loan. We can actually go bigger than that if we partner with Viola, which is the Israeli partner Michelle mentioned, or one of our investors on a loan, or other people in the market. But typically other lenders as well kind of operate in this space. Maybe you might get slightly larger, like I say, but generally that's kind of the space. The loans are fairly short term. So typically you're borrowing for 3 years. It could be a little bit shorter than that. Potentially it could be a little bit longer, but given the loans, given the companies are fairly unpredictable and changing so quickly, it's very hard for someone to assess the risk too far out into the future, and your funding situation and needs may change as well. So typically it's kind of short to medium term lending. That money may be taken upfront or it may be available in the future, like the insurance policy. And you're making payments, like I mentioned before, along the life of the loan. So there's no kind of refinancing wall at a point in time, which is really, really important, because if you're a business which is burning cash and you have an event in the future where you suddenly have to pay back, let's say $2 million, that $2 million has to come from somewhere. And if you're not generating generating profit, then ultimately you have to raise equity to pay back the debt, which is a very hard thing to do. because equity investors want to take shares in the business and want primary money going to the business to help grow it and not just to pay back someone else. From a cost perspective, typically how it works is there may be some fees for putting in place a facility. If the facilities are available over a period of time, you'll pay availability, maybe a line fee, and you'll pay interest along the way. Interest is typically kind of low double digits. It really does depend on the situation, the stage of the business, the risk profile of the business, but that kind of gives you a rough idea. Very flexible, so we're not setting purpose. So it can generally be used for anything. So that can be working capital, anything to help grow the business. So marketing spend, salespeople. It could be used for R&D as well to develop out the technology, can fund acquisitions. Really, it's super flexible. It's senior, like I mentioned, it's limited covenants. From an information perspective and what investors want post-deal, board observer can depend on the sort of investor. We like to take board observer because it gives us a lot of visibility of the business and it means we can be more flexible in other ways. But we're not telling you what to do. It's more we can help you and observe what's going on. And from a reporting perspective, because of that, we see board level information. Typically, people want to see that sort of information and want to be kept up to date through the life of the transaction so they can really understand the business. And the equity component there is the warrant piece I mentioned. Amount really depends on size of loan, valuation of business, type of business. But typically, if you took the warrants, you exercised the warrant and became a shareholder, typically it may be somewhere between kind of 1% to 4% of the business, that kind of level. And the last one there, depending on the provider you work with, some may have the ability to invest equity in your business into the future and kind of build that partnership. So that's what I mean by kind of the right to invest later in the business. So in terms of who can access this product and what you need to look like, ultimately, you need to be at a stage where you've gone past that initial phase of development and you've de-risked somewhat. So if you're very, very early on, I wouldn't recommend taking debt on because you're still finding your feet. You're still developing your technology. It may work, it may not work. There may not be product market fit. We as a lender and other providers in the market want to make sure that you've really built something out, you're selling it and people are buying it, and therefore it's really about how you scale that business further. Therefore, what we look for is, product in market, generating around 3 million of revenues, recurring revenue a year. Your unit economics are kind of stable and improving. And what I mean by that is, you understand what it costs to acquire a customer, what your payback's going to be like on that customer, and how much, lifetime value there is. And these things are really, really important because given you're not making any profits, a way of testing whether the business works or not is whether if you invest another $1, you understand what the return will be. And that really helps lenders understand the kind of future viability of a business and the impact of investing and what the return is going to be. From a kind of equity raise perspective, we say here kind of 3 to 5 million of equity raised, which kind of gets you to around kind of Series A and beyond. We want to make sure that there's investors there from an equity perspective who are backing this business, and therefore we're part of an overall structure. And that's important from a perspective of understanding that something's been developed in the business and you've built an underlying foundation, but also you have other people around the table who are guiding, who are driving this business towards an exit, who are growing the business, who are kind of putting in place corporate governance, and we can be part of that. From a growth perspective, we say kind of 30% plus. Typically, businesses are growing much faster than that, growing 50, 100% plus top line a year. I know that may be variable. It may not necessarily be every single month. And given COVID-19, things are a little bit, more up and down, and we appreciate that. But ultimately, the higher growth you have in your business, the more applicable this product is, because the cost of your equity is much higher. And therefore, the benefit of taking a lower cost product really brings down your overall cost of capital. So that's kind of important. And also, there's a real value there in terms of having money to get you that bit further in your business before the next round. Typically, businesses are cash burning, but we're happy to look at profitable businesses as well. But when you get to a point when you become much more stable and predictable and profitable, then you may be able to access kind of more later stage bank financing. So I mentioned before that the product is cheaper than equity, and this just gives a worked example here of, how that works. So if you take an example where someone requires 3 million of capital, and you have the option of raising equity or raising debt. If the entry valuation is the 30 million pre-money, so by investing 3 million of equity, someone will be taking just over 9% of your business. Let's say the business grows 5x from 30 million to 150 million. If you were purely funding through equity, the equity investor would take about 10.6 million of profit, so knocking off the amount you paid. Whereas if you finance that through debt, actually comparably, you'd actually only be giving away 1.9 million of profit. So really, really big difference, about 5 times cheaper, a little bit more than 5 times cheaper in this example. And that depends on, obviously, if you grow even faster, then the benefit of giving away less shares is even more valuable. But there's quite a big differential between the cost of debt and the cost of equity. And the important thing for that is then founders and other investors can keep more for themselves by taking on some debt funding. So in terms of other types of debt out there, people always compare, venture debt to other products out there and other products which are available at earlier stage. So a convertible note is, for me, I see it more as a kind of structured equity. Investors in convertibles generally intend to put money into the business in the future, but are structuring it around debt for the meantime because they're not setting a valuation and they're protected until the next round. But invariably, it will end up being equity. So therefore, from a cost perspective and a dilution perspective, it's much more dilutive. So typically, an investor would want about 20% of your round. So that's why the dilution is 20% here. It's pretty flexible. Normally, there's an intention to convert to equity. There's not many covenants. It may be secure, but generally unlikely. There could be some cash interest, but generally not. Generally, it'll roll up and impact the conversion amount. And comparing that to venture debt, there's a small amount of dilution from the warrants, but it's typically very small. Obviously, you have to pay interest back on a monthly basis, and it's flexible and it's secured. The amount I'll come back to, but it's very hard to size and give you an exact formula around size of debt in a business. Typically, if you looked at deals, you'd see about 10 to 50% of your ARR you could potentially get as debt. So if you had a business generating 5 million ARR, you may be able to get up to about 2.5 million of debt. But the sizing of debt really depends on many things. So it depends on the nature of your revenue. So whether it's long-term contractual SaaS versus one-off revenue impacts what your runway is going to be, impact the size of round, the investors around the table. So it's lots of different factors, but this kind of gives you a rough gauge. Working capital lines generally are very small and could take the form of, a small receivables line. If you have a lot of receivables, maybe you're acquiring inventory and you can get an inventory line. You may get specific supplier finance. So there's smaller people who give you financing for short periods of time. Typically, you may be borrowing that money for up to maybe 6 months, generally shorter. And you might be able to get that sort of money from a bank. But really, it solves a small part of your capital structure and a small financing need, and it's not going to give you the same level of funding. But generally, it's cheaper as well because banks are taking less risk by doing so. And typically, there won't be warrants, so there's no dilution. But it's not very flexible because it's very kind of focused on what it's used, and generally, it'll be secured. Now, the last one here in terms of revenue-based is something you put in there, and people have started to see it in the market, and there's a couple of players who are looking at doing this in Australia. Effectively, all revenue-based financing is instead of paying a fixed interest rate, you'll basically pay a percentage of your revenue until the loan is repaid effectively. So the interest rate is variable. Typically, it will actually be a little bit higher than venture debt. It'll probably be up to 15–20%. And normally you'd raise a little bit less through this. So normally it's sized off your monthly recurring revenue, and you might access 2 to 4 times MRR. It's pretty flexible because the payments go up and down, but if you're growing your business, those payments will grow each month on month. So it's just something to be bear in mind that it's not that different to venture debt in terms of you are paying interest back, but generally it's going to be a little bit more expensive. We can do a revenue-based financing product as well if people prefer to pay a percentage of revenue rather than interest, but it's just a different way of structuring something. So in terms of when you should not consider venture debt, it's not right for every business. And really, I kind of covered these points already, but if you're not at the right stage, you haven't reached the right scale, your unit economics are kind of all out of whack, really I wouldn't recommend taking it because you're not quite ready yet. And all it's going to do is put contractual payments back to the lender when you're still finding your feet. So it's just an added element of risk at the point when it's not right. On the right, I'm kind of looking here at kind of, well, how are you using that money? So if there's no other option but to raise debt because you can't raise equity or your existing investors don't want to pour more equity in, I really wouldn't recommend it because at that point, it's kind of a last resort and all you're doing is adding risk to the business when there's no equity capital. So I would look to other solutions, maybe look to cut your cost base, maybe you're selling off part of your business, I really wouldn't double down and take risk at that point in time. And a lender probably won't give you money at that point. And likewise, if you're really underperforming or turnaround scenario, I would suggest finding your feet first before taking on additional debt. Because by taking on debt, you're adding, like I said before, fixed repayments, and therefore you're making risk. And lastly, you don't want to over leverage your business. So what I mean by that is putting too much debt in too early. All it's going to do is increase your burn rate too much and put pressure on your business. So in terms of which lender to go to, it's really, really important to consider, if you want to take on venture debt, who you take money from. Because ultimately it's not the same as a banking relationship, which is very, very passive. You take a loan and that's it. Given the business is changing rapidly, you want someone who understands the product, someone who knows that things don't go to plan. And I've seen a lot of businesses and very, very few hit their plan. So it's making sure that lender understands that and understands how to react when things do get difficult. Also, you want to make sure you have a good relationship with them. Ultimately, you're going to have to work with them frequently. You're going to see them a lot. You're going to speak to them a lot. So someone you get along with, someone your investors know and trust is really important as well. So from a size perspective, it's really hard to gauge the size of the venture debt market. A lot of things aren't public in terms of who's taken on debt. Typically, globally, it represents about 10 to 15% of venture financing and about 25% of later stage venture financing. And the graph on the left here is something that came out of PitchBook really recently, actually. They looked at a report on venture debt, and you can see the rapid growth in venture debt. This is in the US. You'll see the number of transactions kind of gone up to about 3,000 transactions a year. And the US, there's over $25 billion US of venture debt per year. So it's a really, really mature and established market in the US. In Europe, my previous fund that I was at before, Kreos Capital, is the largest player and the oldest player doing this in Europe. And they've only been doing it for 20 years. In the Valley, it's been going probably 30, 40 years. But it's growing rapidly in Europe, but nowhere near the size of the US. And Australia is very new and nascent. And really the reason for that, in my view, it's just a question of maturity of market. So the venture capital market here is much more immature. It's been growing a lot and really built out following the GFC. So there's a lot of funds now, there's more and more money in market. And as there's sophistication and more understanding of different products available, venture debt has come into the market and people are getting more familiar. And webinars like this and us operating and other people operating in the market are trying to, educate and get people aware of what exists. And so this is showing real growth in venture debt in Australia. It's not quite ready to get up to the same levels as percentage of market as some of the other markets. But if you kind of gauge it based off size of Australian venture, maybe once you get a bit more mature, you can probably have room for about 150 to 300 million Australian dollars per year capacity, I reckon. So, but we're nowhere near that level at the moment. And the last slide kind of wanted to cover off here is, well, what's changed given current market conditions? So the graph on the left kind of looks at Australian, VC deployment, and you can see really, really strong growth, the last few years. 2020 is obviously a bit of an unknown. Obviously Q1 has been tough, especially in March, and January is obviously quieter because of summer. So definitely expect to see a drop in deployment in Australian equity VC. From a debt perspective, actually, it's an interesting time. So, given there's lots of uncertainty, and that's really, shown by kind of some of the poll results we had earlier in terms of people still being uncertain and people don't know where the market's going. There's a real drop in consumer and business sentiment. There was a Westpac survey which went out and it's kind of huge lows in terms of how people feel about the market and sentiment. There's a drying up of capital because people are spending their existing dry powder from a fund perspective and focusing on their existing investments as well. And therefore there's less money to go around. And lastly, valuations are clearly going to come down. Slightly uncertain where they are, but we'll definitely see pressure on valuations. So in terms of venture debt and how that can help in this market, venture debt provides a source of capital either today or in the future through a credit line. It really avoids that valuation discussion, so that elephant in the room, especially if there's a down round. So there's real advantage in this market. As I mentioned before, it's cheaper than equity, so it's advantageous for founders and other investors to bring down the cost, especially if valuations are coming down, and therefore, from a dilution perspective, equity takes on more dilution. And lastly, it's quick to execute. So it's something you can really put in place quickly, either around a round or just after or between rounds, and therefore the ability to take on money quite quickly when there's uncertainty and needs is hugely valuable. So venture debt is a actually a very useful product in current market conditions. And I also may just give some examples of who's taken venture debt. You know, it's not a niche product, like I said before, that people haven't taken. You know, many of the large tech companies have taken venture debt. So the likes of Amazon, Google, Dropbox, you know, Uber have all taken venture debt. So really commonly used. Even companies in Australia before the product like it is today existed. So WiseTech, Aconex, you know, they've taken similar debt products as well. So it's you know, the product is often used. So that brings kind of a close to the end of the presentation here. Got a couple more poll questions before we go into questions, which will help kind of guide where we are. Let me just bring them up. So following kind of seeing the presentation, would you like, now you kind of probably understand a little bit more, do you think if it was available to your company, you would take it on, or kind of would you be unsure still? It's looking like where we're coming back now, I'll bring up the results in a second, but most people here are saying actually they see it as an attractive product. So I'll bring these up here. So just over half of you are saying yes. There's still quite a few who are unsure and interested to understand why you're unsure. So the last question here is kind of, for those who said no or unsure, like why were you feeling that you wouldn't take it on? Is it because you think you're not quite ready? Or is it really that you don't like the risk profile or the cost of taking on debt? So generally where people are saying that they're still too early, which I fully appreciate. And I think hopefully you kind of understand through the presentation today, kind of when is the right time when you could take it on. So thank you for that. And thanks for your time. I'm going to jump now to our questions.
So Nick, don't go away. I think just in terms of Q&A, people really want to understand in the current market, has your lending criteria changed? And, what happens in the downside case, if we moved into a recession? How does that work, and how do you work with companies through that?
Sure. So look, like I was mentioning, not everything can go perfectly to plan. And we understand that. I mean, ultimately, look, many companies go through ups and downs, and it's really around what does the lender do in those situations. So invariably, look, you'll have payments and agree to a payment schedule. If you're unable to meet that payment schedule because you're low on cash, or there's a change in terms of the profile of the business, look, we're really going to work together and see how can we solve that. So that will be the same conversation you'd have anyway with your equity investors. Do you require further equity investment? Do you need to, cut back some costs in the business? Do you need to decide to sell your business? We're really on board and aligned with your investors through that journey. And that may be, we need to amend our loan a little bit to help reduce, cash burn. I'm very happy to kind of review the business at the time and see how we can help and work with your investors to kind of come out the other side.
Yeah, thanks, Nick. Roland just asked, about the, how much does he have to pay for an upfront for a credit line, and what's the cost for an insurance policy, if you like, as well? Sure.
So ultimately, the cost, it does depend on the situation of the business and how long you want that line open for and the size of the line. But typically, there'll be a small transaction fee for putting in place a facility. Maybe it's kind of 2% of the amount. That can be different depending on the company. And then what we look for as well is, there's the warrant piece as well. So we'd ask for some of those warrants to be paid up front, and some of the warrants to be paid when you take down the facility. And ultimately, that means that we get some return in the event you don't take the money. Ultimately, we're holding money for you. We'd love to give you the money because we've reviewed the business, we like your business. So we get some of that, consideration up front, and then later we get the rest of it. And there may be, depending on the size as well, a small line fee where ultimately you pay a cash fee for the period the line is open but not taken.
Yeah, thanks, Nick. James, just a question for you, if you're there.
Yeah.
Can you talk about how OneVentures sort of supports companies who are using venture credit, and can you give some examples of how we, do more than just provide a facility?
Yeah, that's a great point. So, we take first of all, we take a board observer role. It's not a director seat, so we don't have voting rights, but, the board observer role allows us to stay close to the company and do all the things that are, most of the things that a venture capital investor does. So as Michelle said, we have 120 investors who run businesses, ultra high net worth individuals who run investments across the country. We can introduce them to them, help them close contracts. We've introduced them to those investors who sometimes put in a couple $1 million in equity, who've put in a couple $1 million of equity as well. We are in 6 SaaS businesses, for example, so we can see trends across different SaaS businesses, learnings, help them connect with different salespeople, marketing people, connect them with CTOs. So I guess all the things that you'd look from a venture capital investor, but just with a different structure.
Yeah, thanks, James. Nick, do we ever offer anything like revenue-based financing?
Yeah, so far we haven't.
I think you're out of screen, but
hello? Yeah, can you hear me?
Yeah.
So far we haven't offered any revenue-based financing. I think it's very new and we haven't had demand for that. We're very open to doing a product like that. It's really a question coming back to the company looking for finding money. So if they're interested in a revenue-based financing, because that gives them some more comfort that if their numbers come down, they pay slightly less for that month, happy to consider that. It's just ultimately a slightly different structure.
Mm. And what are typical covenants that people are likely to see if they take a venture credit facility with us?
Sure. So typical, as I was saying before, typical credit covenants in later stage don't apply to early stage businesses because they're all around profitability, all around kind of inflows versus outflows. And if you're still at a stage where you're pre-profit and burning cash, you're not quite ready for that. So where there are covenants, it may be that if you have a facility open, you need to be at a certain stage potentially to take down some money because you're not quite ready yet. That's around revenue levels. We may look at covenants around ensuring that some of your unit economics are still kind of in line and not going hugely off track. So that could be, depending on your business, could be looking at churn levels to make sure your churn isn't really, really high, or margin, or areas like that. It's very molded to the specific business.
Yeah. So we had some questions before the start of this, and James, people want to understand what the difference is between a venture credit product and an R&D loan. Can you maybe explain that?
Yeah, sure. So an R&D loan is basically, in Australia, you get your R&D grant from the government around September, and you might be able to use an R&D lender to give you that money up front, and then they take the R&D grant payment directly from the government. So it's factoring essentially. It's an okay form of finance, but venture debt allows you, if you can access it, to get much more than just 80% or 70% of R&D. You can get more. We do more like multiples of your revenue, or multiples of, or fractions of the whole round. Also, R&D loans are only until the next R&D payment comes out. So we're doing more like 3-year loans. So I think we have actually had some companies do in our portfolio do small R&D loans, and it can be useful, but it's more of a short-term measure than a longer-term funding source.
Yes, we've got a few questions about, the difference between venture credit and convertible notes, Nick, and maybe you can just explain that. And also they want to understand, are our venture loans convertible into equity?
So typically they're not convertible into equity. So we look to lend, and we're comfortable with a debt risk, and ultimately we're comfortable with the return we'd get through the debt product. So what I mean by that is we're not looking for lots and lots of equity upside. We have a small amount of upside through the warrant, the equity option, but that's relatively small compared to the amount of funding. So a convertible really is the investment is looking to take upside in the equity, but wants some protection in the short term. So maybe that's because there's not a valuation today, and you'll put in place a convertible, which will set as a discount to your next round. But the intention really for someone investing for a convertible is to convert and invest. So they want to buy shares, but they're not doing it today. Whereas for us, we're not looking to buy shares. So we're ultimately happy with the debt piece and the return on the debt, and we wouldn't convert in the future. So that's kind of the key difference. Convertibles may have a time period which they convert. They may be forced to convert on a funding round. They may not. Yeah, that's kind of the difference between the two.
Yeah. So James, some businesses aren't suitable for this product. you know, would, for example, you know, a business in the travel sector be looking to access this funding right now? What types of businesses also do you think might not be suitable for the product?
Yeah, so I mean, we'll have a look at almost anything. Like VC funds, we see tons of, you know, hundreds of deals a year, and we're happy to speak to anyone. So don't rule yourself out and think that I'm not appropriate. We're happy to have a chat and build a relationship if you're early. And so that's my starting point. You know, we are actually looking at some things in the travel area now, and even though it's been hit hard, travel, hospitality, you know, we take like a longer run view, and if there's support there to get it through this downturn, this short-term downturn in those areas, then we're happy to look at those sectors too. I think things that are not good areas for us, things with very, very low margins, like hardware, can sometimes be tough. And I suppose the main thing for this audience would be too early probably means that it'll be a build the relationship conversation as opposed to progress to investment conversation. But it's hard for me to say, and I guess things in the that are not technology related are not areas for us as well.
Yeah, and just to add as one further point on that, it's like if your business is very binary, so you know you may have a huge equity upside if something goes well, but there's a risk that it really fails, then it's probably more suited to equity, because as a lender you wouldn't benefit from that real upside, but you would get really hurt on the downside. So you know, if you're things like, I don't know, potentially space companies or companies where there's, you know, a lot of you know, a lot of research, a lot of development before you then go live and try and launch something, but it may fail. So, you know, on our equity fund, you know, we specialize in healthcare as well. From OneVentures' point of view, you know, drug development is very different, for example, than a SaaS business.
Yeah, so what do people have to do in terms of reporting, Nick? You know, if they've taken the venture credit product, how onerous is it on the company?
Yeah, I mean, our policies, we want to make it as like least onerous as possible. So we don't want to create extra admin for the companies. So invariably, normally they're producing, you know, monthly reporting back to investors in terms of, you know, management accounts. You know, there's board packs which talk about, you know, strategy and you know, runway and you know, direction of the business. So generally, we're fine to get the same information other investors get. We're not asking for set reporting on a month-by-month basis. We really want to be kept in the loop so we understand the progress of the business. So we try and make it as easy as possible.
Yeah. So James, do you think you know, taking on venture credit is a problem when you're going to do capital raising? Or, you know, people are asking also, when would our fund look to invest both, you know, equity and debt in combination?
Yeah, so that's a great question, because I think a lot of people have that worry. And when we were starting out, a lot more people had that worry. If I raise venture debt, can I raise equity, or will the equity investors say, why do you have this, why do you have this loan on your balance sheet? Will my money be used to pay out the loan? And as it's become more mature, and all the VC funds are now very comfortable with them, I would say every VC fund has multiple companies with venture debt loans, so that's no longer really a concern. And that's also why we don't make our loan repayable on the next round, because that creates a real funding wall. That's why we have it amortize out to smaller payments. So I would say it's not a concern at all anymore. And I think, to be honest, a lot of VC funds now think it's quite a smart form of capital. And sometimes where we do some investments, or we look at some investments where there's no VC in, the fact that we've given the company a venture debt loan means it kind of certifies the companies up to a certain standard, and it can be kind of a positive filtering effect. When OneVentures would look to do both equity and debt is not in most our cases. We have done that. So we have done that actually. I would say that's in the later stage businesses where they're doing 5 million plus in revenue, 5 to 10, where they're safer, and we feel like we have a conflict issue there. So we kind of don't like to cross that conflict unless we feel very, very safe about it. For the ones which are a bit riskier, we wouldn't take that extra risk.
And when would the debt fund, you know, the debt fund has a bit of capability?
Oh, that's true, yeah.
When would that happen?
So yeah, the debt fund, I think, has 10 or 15% ability to put equity in as well. I think we would do that when we get to know that, after doing a venture debt loan originally, getting to know the company, and we just see this as just a fantastic company, and for some reason the VC market is missing it, or it's not investable by traditional VCs for some reason, some kind of, exceptional circumstance, which do come up actually here and there for different reasons, then I think then we would look to put some equity in alongside it too.
Yeah, so Nick, we've had a question about, why do we need warrants? And, that taking sort of 1 to 4% of the company might sound a bit high, with a double-digit interest rate. Is there ever a circumstance where we don't take warrants? What would that look like? Or is it something we always do?
Yeah, I mean, for us, we always like to take warrants, and it comes back to the piece of aligning interests. So ultimately, if we have a stake in the business and we benefit from value creation, then we're ultimately more likely to take better decisions in the future. So, if things are tough, we want the business to survive. We want the business to move on and go in a direction to maximize value. And if we participate in some of that, that really aligns our interests with the other shareholders. That's why we like that. We don't have to, ultimately there can be situations where warrants may not be right. And in those circumstances, we will, we could do a loan without the warrants. We just want to make sure the overall return, compensates us effectively for the risk.
Yeah, thanks, Nick. Just, following on from that, when we're looking at companies and assessing the risk, what are the major limitations of venture credit for a startup compared to a scale up? And people want to know, is there a sweet spot for venture credit? What does that ideal business look like?
Sure. So try to cover those bits in the presentation, but ultimately you're generating, I'd say, 3 to 5 million recurring revenue. So you're kind of at that stage. The sweet spot's really, I suppose, any period from when you're still in a period of high growth, you're still trading off profitability for growth is important. And you want the flexibility of a product which isn't restricting you on how you can use it and what you can do. So, if you look to other larger markets, venture debt can be pretty large checks as well. You have venture debt in the hundreds of millions of dollars size. So it's not just a product for, very early stage. Ultimately, once you get to and it also applies to public companies as well. So we've actually provided loans to one public company, and there's many people globally who provide loans to venture debt to public companies as well. So it's kind of a stage whereby you're not yet year-on-year stable profits because you're choosing not to be, or you're not quite at that stage. And therefore having a product which allows you to kind of have the access to funds, but not be restricted, that's kind of key.
Yeah, so James, what's the uptake trend in Australia, and what do you see in the uptake growth here? What's the reasons behind that?
Yeah, so I think venture debt's gone from, let's say, near zero a few years ago to, I would guess, maybe 50 million a year here now, maybe a bit more. So that's quite a lot of growth. I think the big trend is being driven by, one, just the growth of the number of startups in Australia. There wasn't really much of a market for startups until maybe 5 years ago, or maybe that's when a lot of the startups maybe started 7 or 8 years ago, started to hit a kind of reasonable size, and they kind of became venture debt backable. So I think, just the number of companies that can raise money, new funds like ours, I think US and maybe some European funds and Israeli willing to invest overseas more has brought some deal flow in there. So, and I think probably another one in Australia is the rise of a lot of fintechs. So online lenders, personal lenders, business lenders, or afterpays. These companies, a lot of them raised venture debt along the way, and that's quite a fintechs are quite applicable to venture debt because they have loans they need to fund as well, and often they fund that through venture debt loans. So I think those are the main trends.
Yeah, so Nick, how do you size a deal for venture credit? People want to understand, how much they could borrow for what type of company. And
I think ultimately there's no kind of set rules, and the reason for that is it's quite holistic in terms of our analysis and our decision to lend. So ultimately, I think it's a factor of other things. It's kind of, well, how much are you raising from an equity perspective? Often debt is part of that. So it's rare to get a round where you're going to raise more than 50% debt, 50% debt of the round. So typically it'll be smaller than that. And the earlier stage you are, the smaller that will be. So it may be as low as 25% of the round when you're much smaller, and it may go up to that 50%. So that's kind of one way of a guide. The second guide is kind of how large you are from a revenue perspective. So that was kind of my piece before around 10 to 50% of ARR is another way of guiding it. Also kind of, what's your monthly burn? So you don't want the debt payments to suddenly, double your monthly burn. So it's understanding kind of what your burn is today, what the debt does for you from a runway perspective as well. It's got to, really assess, well, how much do I want to raise? Could I reduce that dilution by taking some debt? And really come to us and say, look, we're thinking of wanting to raise some debt. We're thinking this amount, and we'll be quite upfront and say, look, that's too much. That's, potentially we could lend you more, and we'll gauge it from there. There's no set formula, unfortunately.
Yeah, sometimes people too can, might be eligible to get a bit of bank debt, but why would they look to venture debt instead?
So I suppose it comes down to flexibility and size. So if the bank will lend you $500,000 and that's all you require, then that may be the best option for you. And don't think venture debt's always right. But if you want further capital, let's say in that situation you're looking for $3 million, then if you need that further money and you see the advantage of taking debt rather than equity, then bank may not be right. And two, the bank will definitely, for early stage businesses, set covenants. So the bank will say, you have to use the money for this use case. You must hit these milestones. And if you don't hit them, they'll just take their money back straight away. So they're very black and white in terms of whether they're happy or not happy. Whereas for us, if you don't go exactly to plan, we can stay with you, work through you and work through that process. And the reason we're happy to do that is we're making, a slightly higher return than the bank would.
Yeah, that's good. People want to understand a bit about companies that are too early. Would we ever consider an equity stake and a credit stake at the same time?
Ultimately equity would always come first in terms of your funding journey. So if you're too early to access debt, then from a OneVentures perspective, we wouldn't put equity, if we're looking at our debt fund, we wouldn't put equity in before debt to kind of what James was picking up earlier in terms of when we could do equity. So really debt would always come first from a debt fund. So if you're not quite ready for that, really you're looking for equity funding, and you'd probably go to an earlier stage equity provider, whether that's a seed fund or a Series A fund before you come to us.
Yeah, so I'm just reading through some of the other online questions coming through. James, when we look at typical arrangements, how long is a typical loan term, and are there any arrangements like principal holidays available?
Yes, so typical loan is 3 years, maybe 4 years. And yeah, we normally do, or often do, an interest-only period at the start, 3 or 6 months, and then 30 months, say it's a 3-year loan. So it'll be 6 months where you're just paying interest, and then 30 months where you're paying back a 30th of the principal plus the interest each month.
Mm. Yeah. And outside of OneVentures, James, are there other venture credit providers?
Yeah, there's a few now. Each kind of has their own personality and advantages and disadvantages. I think we position ourselves as being more equity-like, so we get a bit closer to the business. We can take advantage of the OneVentures platform, the investors, the equity side of the business, and some are a bit more bank debt-like, so they'll kind of give the loan and kind of make sure you do the interest and principal payments, but aside from that, we won't have that much contact with you. And I think some people prefer different approaches, and so it's kind of up to the borrower or the venture debt investment receiver to kind of decide what is, who they have the best relationship with, who they feel the best connection with, and what suits them.
Yes. So Nick, just when we're thinking about this sort of concept of insurance policy, people have asked whether there's obligations on the drawdown and how that works. Does it expire? Does it lapse? And are there covenants that get put in those agreements as well?
So in terms of time, it would lapse. So we would only have an open line for a period of time. And that length of time really does depend on kind of our comfort around the business and kind of how predictable and how much visibility we have. So the further you go out into the future, it's more uncertain. So we're less comfortable saying, look, this line's open for 5 years, because who knows what the business will be like in 5 years. So typically the line may be open for 6 months, 12 months, that kind of period of time. In terms of, are there conditions to meet to draw down? Again, it will depend. If the business isn't ready or not of a scale to take the money today, then definitely there may be some conditions that you have to reach a certain level. If we're comfortable lending the full amount today, then it may be there's very limited conditions in the future. Obviously, we'd want some protection if the business suddenly just went off a cliff and collapsed. We wouldn't want to fund you, and to be honest, you wouldn't want to take the money at that point. So really, we should be aligned that if the business is doing well and it makes sense to take the money, then we're all open. You know, even if it's obviously if it's using his insurance policy, the business may be underperforming plan, and again, we're comfortable. But if it's, you know, it was due to be generating 5 million in revenue, suddenly it's, you know, down at 500,000, then there's a real issue to kind of work out first.
I think we're getting down to our last couple of questions now. So, you know, people want to understand is the cost if they pay the debt out early, if they take venture credit.
Yeah, and look, there is a cost, and it depends when you take down that money. Ultimately, we're assessing your business. We're deciding to lend to you. We have investors who are trying to make a return on the loan, so we want to make sure we make a base level of return. So there would be some cost, and effectively that cost will come down through the life of the loan. So if you paid us back, you know, 1 month after taking the money, it's going to be much more expensive than you paid us back 2 years into the loan.
Mm-hmm. And when we come into, you know, if there was ever a default under our contract, how does the enforcement process work?
Yeah, so I suppose the question is what's the default being caused by? You know, if the default is, you know, you've not provided us some information and we don't know what's going on in the business, we'll just pick up the phone and try and work it out. You know, that's not really that material. If you're suddenly not paying us anymore, and that's because you've run out of money, and clearly that's very different situation. But it may be that you can't pay 1 month and you come to us and say, look, can we change the loan? And again, we're in open communication to work through that. So we're never looking to suddenly enforce and say, give us our money back, because you can't really pay us back in that situation. So enforcement can take many different forms. I mean, I can talk from my own experience, and what we've done is it's very, very rare that, you know, if there's a problem, we're suddenly going to demand our money back. We really sit down and try and work through things, and normally that will mean that you take on some more equity, you amend the loan, and you move on forward. So you kind of solve the problem, I suppose. In a situation where nothing can be solved, and look, as we all know, some businesses do go wrong and go bankrupt, and that's part of being in the venture space. If that happens, then it goes into the normal bankruptcy process, and we'll be senior. So.
Yeah, so maybe we can just end on a positive note with both of you, and maybe you and James both mentioning, you know, how venture credit has helped some specific companies.
Sure. So I can give, you know, example of companies in our portfolio. You know, a company called ShipIt, which is a business doing software in e-com fulfillment. We participated in providing some debt alongside the existing investors at the back end of last year. So they raised just over 5 million in terms of a combined debt and equity raise. Through taking on some debt, we help reduce dilution for those investors around the table, specifically founders who aren't participating at round, and also other earlier stage investors who weren't participating. So ultimately, we helped reduce dilution. We provided funding to help that business grow forward, and it's, you know, performing very well in the current market. So
yeah, and I can talk to the example of Hometime, which was our first venture debt deal. So Hometime is Australia's largest provider of largest platform for Airbnb management. So people managing other people's Airbnbs, they use Hometime to maximize occupancy and arrange cleaning, so forth. So they had a merger they were going to do with a European equivalent of them that fell apart, and then they suddenly had very short runway. They didn't want to do an equity round because they felt like they were about to go into really the summer period, which is a great period for them. So we did a venture debt loan that got them through their summer period, which had great results, and we actually helped them raise equity. One of our investors put a few $1 million into the business, and then from there they went on to raise from NAB Ventures and AS1, so from two VCs, and they were skyrocketing. Now COVID's hit them quite hard, but you know, long term we're fine with the business. They said, look, we're going to struggle to pay. Well, it's a large amount to pay when revenues have dropped almost to zero, and we've restructured that loan, allowed them to pay less for a certain amount of period. And I think that not only kind of getting them to the initial rough period, but now the second rough period without doing what a bank would do, which is say, give us our money back. You know, we're going to take the business. We've been, you know, great, and I think that they really appreciate that flexible approach, which is suitable to startups.
Yeah, so at the end of the day, it's a real partnership, isn't it, between us, the portfolio companies, much like venture investors. You know, we form a partnership, and you know, we're on the journey, on the way as well. So I think we might wrap it up there if there are I think we've dealt with a lot of the questions that have come through.
There I am. Thanks, Michelle, Nick, and James. Excellent. Typical of you guys to have so many questions come through and for it to be going longer. And that's great to see that we're able to answer so many. One of the questions actually that we got direct was for Nick to be a guest speaker at a university. So I'll pass that on to you, Nick. You must have done something right there. Thanks again for joining us. Keep an eye out for slides, which will be sent, a version of the slides and a recording will be sent out to you all, as well as a survey. And thank you so much for joining, James, Nick, and Michelle.